Most traders don't lose money because their strategy is bad. They lose money because they refuse to accept being wrong. A loss doesn't feel like part of the game to them. It feels like an insult, a mistake, something that should not have happened. So they fight it. They widen stops. They hesitate to exit. They tell themselves it will come back. They don't take the loss. They negotiate with it. And that single habit quietly destroys more trading accounts than bad entries ever will. You see it everywhere. A trade goes against you, and suddenly it's not just about money anymore. It's personal. Your heart rate picks up. Your mind starts racing. You replay the analysis. You look for reasons the market is wrong, not you. You tell yourself the setup was perfect. That price just needs a little more room. That closing now would mean admitting failure. So you wait. And what should have been a small, controlled loss turns into something far bigger. Meanwhile, a small group of traders experience losses very differently. They don't like losing, but they aren't disturbed by it either. Losses don't stick to them emotionally. They don't replay them all day. They don't carry them into the next trade. A loss happens. The trade is closed. And mentally, it's already over. Same markets, same instruments, same risks. Completely different reaction. So what's the real difference? It's not knowledge. Plenty of traders know that losses are part of trading. It's not experience either. Many traders have years of screen time and still panic when a trade goes red. The problem isn't that traders don't understand losses intellectually. It's that they don't accept them psychologically. And until that changes, no strategy, no indicator, and no amount of discipline will save them. Part 2. Why losses feel unacceptable. To understand why most traders cannot accept losses, you first have to understand what a loss represents in their mind. On the surface, it looks like money, a number going down, a red figure on a screen. But psychologically, a loss is rarely about the money. It's about what the loss seems to say about you, that you were wrong, that you misread the market, that you failed to see something obvious. And for many traders, that feels far more painful than the financial hit itself. This is where things quietly go wrong. In almost every other area of life, a loss usually means a mistake. If you fail an exam, you didn't study enough. If a project fails, something went wrong in the process. If you lose a game, the other side played better. From a young age, we are trained to associate losing with error and winning with correctness. Improve the process, reduce mistakes, and losses disappear. That logic works almost everywhere, except here. In trading, you can do everything right and still lose. You can follow your rules perfectly, manage your risk correctly, time your entry well, and still watch price hit your stop. And that creates a mental conflict most traders never resolve. If losing means being wrong, and you were right in your execution, then what exactly does the loss mean? The brain doesn't like that ambiguity, so it tries to resolve it in the worst possible way. It assumes the loss should not exist. This is why traders don't just take losses. They argue with them. They delay them. They soften them. They treat them as temporary problems that need fixing instead of final outcomes that need accepting. The moment a trade goes against them, a silent negotiation begins. Just a bit more room. Just a little more time. Just one more candle. Not because the plan changed, but because accepting the loss feels like accepting something about themselves they are not ready to face. Consider two traders taking the same trade. Same entry, same stop, same target. Price moves against them and hits the stop. The first trader feels a surge of frustration. His thoughts immediately turn inward. Why did I take this trade? I should have waited. Maybe the market is choppy today. He replays the loss again and again, looking for a reason it happened. The loss lingers. It affects the next decision. He either hesitates or overcompensates. The second trader feels the loss too, but it lands differently. The trade followed the plan. The risk was defined. The loss was already accepted before the trade was placed. Emotionally, it's done. The difference is not toughness or detachment. It's expectation. Most traders enter trades hoping not to lose. Profitable traders enter trades knowing they will lose sometimes. That single distinction changes everything. One of the biggest reasons losses feel so hard to accept is the need to be right. Being right feels safe. It feels validating. It feels like control. Being wrong feels exposed. It feels like uncertainty. And when money is involved, that discomfort multiplies. So traders subconsciously structure their behavior to avoid being wrong for as long as possible. They move stops. They add to losing positions. They turn trades into long-term holds, all to delay the moment where they have to say, "This one didn't work." Another reason losses feel unacceptable is that they often feel unfair. The setup looked perfect. The analysis made sense. Everything lined up, and yet the trade still failed. The mind struggles with this because it expects fairness from effort. If you prepare properly, you should be rewarded. But markets don't work that way. They don't care how good the setup looked. They don't care how confident you were. They only distribute outcomes across probabilities. When traders don't accept this, every loss feels like a violation instead of a normal event. Then, there is the problem of short-term pain. Losses hurt immediately. The emotional discomfort is instant. Logic, on the other hand, operates long-term. You know in theory that taking a small loss is correct. But, in the moment, your brain prioritizes relief over consistency. Avoid the pain now. Deal with the consequences later. That's how small losses turn into big ones. Not because traders don't know better, but because discomfort speaks louder than logic in real time. And finally, most traders treat losses as exceptions. This one doesn't count. This one is different. This one should have worked. Rules apply when things go well, but bend when things don't. Losses become special events instead of routine costs. And once that happens, acceptance disappears entirely. By this point, the pattern should be clear. Losses are not rejected because traders are careless or undisciplined. They are rejected because losses threaten identity, comfort, and certainty all at once. Until that is understood, losses will always feel unacceptable, and trading will always feel like a fight. Part 3. The shift that changes everything. Here's the part most traders miss. Profitable traders don't accept losses after they happen. They accept them before they ever enter the trade. That single shift changes the emotional experience of trading completely. When a loss is already accepted, it loses its power. It no longer feels like a surprise or a threat. It becomes an expected cost, not a personal failure. Most traders do the opposite. They enter trades emotionally neutral, or even optimistic, telling themselves this one will work. They imagine the win. They picture price moving in their favor. Loss is treated as something distant, unlikely, almost hypothetical. Then, when price turns, the loss arrives uninvited, and because it wasn't emotionally accounted for, it feels violent, sudden, wrong. That's when panic and negotiation begin. The traders who handle losses well flip this sequence. Before they click buy or sell, they already know where they are wrong. They know how much it will cost them if they are wrong, and most importantly, they are emotionally okay with paying that cost. If they aren't, they don't take the trade. The acceptance happens up front, when the mind is calm, not in the heat of the moment when price is moving. This leads to the first real shift. Losses stop being something to avoid and start being something to manage. A loss is no longer evidence of failure. It's proof that the system is being executed. When you truly accept that a valid trade can lose, you stop trying to save it. You let it play out, and that alone prevents more damage than any risk management rule ever will. The second shift is separating losses from self-worth. Most traders say they've done this, but very few actually have. You can tell by how they react. If a loss ruins your mood, affects your confidence, or changes how you see yourself as a trader, then the loss is still personal. Profitable traders don't feel good about losses, but they don't internalize them either. A loss says nothing about who they are. It only says that this particular trade didn't work. This is why they focus so heavily on execution. Did I follow my rules? Did I manage risk correctly? Did I exit where I planned? Those questions matter more than the outcome. When success is defined by behavior instead of money, losses lose their emotional sting. They become neutral events, forgettable, and that emotional neutrality is what allows consistency to form. The third shift is redefining what a good loss actually is. Most traders think a good trade is one that makes money, and a bad trade is one that loses. That definition is backwards. A good trade is one that follows the plan. A bad trade is one that doesn't. Some good trades lose money. Some bad trades make money. The market doesn't care about your definitions, but your psychology does. Once you understand this, losses stop being failures and start being feedback. Not feedback about your intelligence or talent, but about whether you're executing correctly. A loss taken exactly where it was planned is a success. A loss avoided by breaking rules is a future problem disguised as relief. The fourth shift is learning to think in samples, not moments. Most traders experience each loss in isolation. This trade, this entry, this outcome. That's why losses feel heavy. They carry too much meaning. Profitable traders don't think that way. They think in series. 10 trades, 50 trades, 100 trades. In that context, one loss has no emotional weight. It's just one data point in a much larger process. When you zoom out like this, the urge to interfere disappears. There's no need to save a single trade when you know it doesn't matter on its own. Your job is not to protect each trade. Your job is to protect the integrity of the system across many trades. That perspective alone creates patience and discipline without forcing it. The fifth shift is letting go of the need for validation from the market. Many traders secretly expect the market to reward them for their effort, for their analysis, for their patience. When it doesn't, they feel betrayed. Profitable traders don't expect fairness. They don't expect confirmation. They don't expect the market to care. They understand that the market owes them nothing. And because of that, losses don't feel like rejection. They feel normal. When these shifts come together, something subtle but powerful happens. Losses stop demanding attention. They don't dominate your thoughts. They don't shape your identity. They don't bleed into the next trade. They are handled, recorded, and forgotten. And that emotional quiet is not weakness. It's strength. This is why the traders who accept losses best often look calm, even bored. There's no internal drama when a trade doesn't work. No spiral, no story, just execution. That's the point where trading stops feeling like a fight and starts feeling like a process. Part 4. When losses stop controlling you. At a certain point, accepting losses stops being something you try to do and starts being part of who you are as a trader. This is the identity shift most people never reach. Losing traders see losses as problems to solve. Profitable traders see losses as transactions. One creates tension. The other creates stability. And that difference compounds over time. When losses are no longer personal, trading becomes quieter. A losing day doesn't feel heavy. A winning day doesn't feel euphoric. Emotional swings flatten out. Decisions become cleaner. You stop second-guessing yourself after a stop is hit. You stop replaying trades in your head. You stop trying to make the next trade fix the previous one. Each trade stands on its own, disconnected from ego and emotion. This is also where discipline becomes natural instead of forced. Most traders try to control themselves through effort. They promise not to move stops. They promise not to overtrade. They promise to follow the plan next time. But discipline built on resistance is fragile. It breaks under stress. Discipline built on acceptance is different. When losses are already accepted, there's nothing to resist. There's no internal argument to win. The rules are followed not because you're trying to be strong, but because there's no reason not to. This is the boring truth about losses. Truly accepting them is not dramatic. There's no breakthrough moment, no emotional release. Losses simply stop mattering in the way they used to. They still cost money. They still exist, but they don't carry weight. They don't define the day. They don't define you. They become routine, expected, almost forgettable. And this is where many traders get uncomfortable. They think something is missing. Trading feels flat, uneventful, too quiet. But that quiet is not a problem. It's a signal. It means emotion is no longer driving decisions. It means consistency has space to form. If trading feels exciting, losses probably aren't accepted yet. If trading feels stressful, losses are still being fought. When trading feels calm, mechanical, even dull, that's usually when things are finally working. In the end, nothing about the market changes. Losses keep happening. Wins keep happening. The market doesn't care whether you accept them or not. The only thing that changes is how much damage losses are allowed to do. You can keep treating them as threats, fighting them, arguing with them, and letting them shape your behavior. Or you can accept them up front, manage them cleanly, and move on without carrying them forward. Most traders never make this shift. They spend years trying to avoid losses instead of learning how to live with them. A small group does the opposite. They accept losses early, completely, and without drama. And because of that, they last longer, think clearer, and give their edge time to play out. If this perspective resonates, keep following the channel as we share more trading insights, real trading stories, and practical motivation in future videos.